Tired of chasing flashy growth stocks only to watch them fizzle? What if I told you the path to consistent, high-paying income doesn't involve complex trading strategies or risky bets, but rather something, well, a little more mundane? Many investors overlook the power of boring investments, yet these are often the quiet workhorses that consistently deliver substantial payouts year after year. Today, we're uncovering 5 such income-generating powerhouses, focusing on their potential to keep paying handsomely, even looking ahead to 2026 and beyond. Prepare to redefine what exciting means for your portfolio. Let's begin by shifting our mindset. Boring in investing often translates to reliable and predictable. While the media celebrates exponential tech gains, a significant portion of investors are quietly building wealth through consistent income, aiming to supplement their lifestyle or fuel further growth. The allure of high yield is powerful, but it's crucial to understand the engine driving that payout. This brings us to our first category, covered call ETFs. These funds implement a strategy where they own a portfolio of stocks and simultaneously sell call options on a portion of those holdings. This generates immediate income from the premiums received, which is then distributed to shareholders. The trade-off? While you gain a consistent income stream and some downside protection up to the premium amount, you also cap your upside potential. If the underlying stocks surge dramatically, the fund might miss out on those extraordinary gains because it's obligated to sell its shares at the strike price. However, for income-focused investors, this predictable monthly cash flow can be incredibly appealing. Take, for example, the J.P. Morgan Equity Premium Income ETF, or JEPI. This fund doesn't just write covered calls, it utilizes a more sophisticated strategy involving equity-linked notes, or ELNs, to generate its income. This allows JEPI a bit more flexibility in how it manages its options overlay, often resulting in a more consistent and attractive distribution yield compared to simpler covered call strategies. It holds a diversified portfolio of large-cap U.S. equities, aiming for lower volatility and a steady income stream. For investors seeking similar exposure but with a tilt towards higher growth tech stocks, there's the J.P. Morgan Nasdaq Equity Premium Income ETF, or JEPQ. While it employs a similar covered call strategy to JEPI, its underlying holdings are primarily Nasdaq-listed equities, meaning it generally carries a higher growth potential but also potentially greater volatility. Both JEPI and JEPQ offer monthly distributions, making them ideal for those who value regular cash flow. They are managed by experienced teams, adding a layer of professional oversight, which can be reassuring for investors navigating complex income strategies. Understanding the mechanics of how these funds generate income rather than just chasing the headline yield is paramount to making informed investment decisions. This strategy is particularly effective in sideways or moderately rising markets, providing a buffer against declines and a consistent income stream even when significant capital appreciation is elusive. However, remember, no investment is without risk, and the capped upside during explosive bull runs is a key consideration for these types of funds. Do you find this video valuable? Kindly like and share the video so that other investors will get to see it. Also, subscribe so you don't miss any of our valuable investment informations. Comment where you're watching from so we tailor our next video to your interest. Moving on to our next category of income powerhouses, we delve into business development companies, or BDCs. These entities often fly under the radar, yet they play a crucial role in the economy by providing financing to privately held small to medium-sized companies that typically cannot access traditional bank loans or public capital markets. Think of them as specialized lenders, often offering debt and sometimes equity to these growing businesses. The reason BDCs offer such compelling yields stems from their regulatory structure. They are mandated to distribute at least 90% of their taxable income to shareholders annually, similar to REITs, to avoid corporate income tax. This pass-through status ensures a high dividend payout. However, with higher yield comes increased risk. BDCs are exposed to credit risk, meaning the possibility that their borrowers may default on loans, especially during economic downturns. Their portfolios are often comprised of higher-yielding, less liquid loans, which can fluctuate in value. Interest rate changes also significantly impact BDCs. While some have floating rate loans that benefit from rising rates, others might face increased borrowing costs or a tougher environment for their borrowers. Consider Pennant Park Floating Rate Capital, or PFLT. This BDC focuses on providing first lien senior secured loans to middle market companies. Its emphasis on senior secured debt means it typically holds a higher priority claim on a borrower's assets in the event of default, offering a layer of protection. PFLT's loans are predominantly floating rate, which can be advantageous in periods of rising interest rates, potentially leading to higher net interest income. Another prominent player is Heirs Capital Corporation, or ARCC. ARCC is one of the largest publicly traded BDCs, known for its diversified portfolio across various industries and a mix of debt and equity investments. Its size and scale allow for greater access to attractive lending opportunities and potentially better diversification, spreading risk across hundreds of portfolio companies. ARCC has a long track record of consistent dividends, often seen as a bellwether in the BDC space. When evaluating BDCs, it's vital to look beyond just the dividend yield. Examine the quality of their loan portfolio, their underwriting standards, management's experience, and their balance sheet health. A strong balance sheet with manageable leverage and access to diverse funding sources is a positive indicator. The hidden aspect of BDCs often comes from their focus on private, less glamorous companies. But for income investors, their consistent distributions can be a powerful component of a diversified portfolio aiming for regular cash flow, particularly as we move towards 2026 and potential shifts in interest rate cycles. Before we continue, it's obvious you are getting value from this value-packed video. Why don't you kindly share and like the video to help other investors see this video? Also, tell us where you are watching from. Our third income-generating category brings us to real estate investment trusts, or REITs. These companies own, operate, or finance income-producing real estate across various sectors, from apartments and offices to data centers and healthcare facilities. Like BDCs, REITs are legally required to distribute at least 90% of their taxable income to shareholders annually. This structure allows them to avoid corporate income taxes, passing the rental income directly through to investors in the form of dividends. This makes REITs a cornerstone for many income-focused portfolios. However, REITs come with their own set of risks. Their performance is highly sensitive to interest rates, as higher rates can increase their borrowing costs and make their dividends less attractive compared to fixed income alternatives. Additionally, specific sectors within real estate can face unique challenges. For instance, office REITs struggled during the pandemic, while industrial and data center REITs thrived. Tenant concentration risk, where a significant portion of income comes from a few large tenants, is another factor to consider. Let's look at Omega Healthcare Investors, or OHI. This REIT specializes in financing and owning skilled nursing facilities and assisted living facilities. The healthcare real estate sector benefits from strong demographic tailwinds, primarily the aging global population, which drives demand for such services. However, OHI also faces risks specific to the healthcare industry, including government reimbursement policies, Medicare, Medicaid, and the financial health of its individual operators or tenants. Despite these sector-specific nuances, OHI has historically offered a very attractive dividend yield, appealing to investors looking for exposure to this essential service industry.
While we are focusing on high-paying, boring income, it's also important to acknowledge investments that fulfill different roles. For instance, the Schwab U.S. Dividend Equity ETF, or schd, is often discussed in dividend circles, but it's crucial to distinguish its role. schd is not primarily a high-yield fund. Rather, it's an exceptional dividend growth fund. It selects companies based on fundamental strength and a consistent history of increasing dividends. While its current yield might be moderate compared to the covered call ETFs and BDCs we've discussed, its strength lies in the compounding power of growing dividends and potential capital appreciation over the long term. schd aims for reliable dividend growth, making it suitable for investors who prioritize a steadily increasing income stream and total return rather than just the highest immediate payout. Therefore, for an income portfolio looking at 2026 and beyond, a blend of high-yield instruments like OHI and dividend growth stalwarts like schd can offer both immediate cash flow and future income appreciation, balancing different aspects of a robust income strategy. Beyond these core categories, the broader landscape of income-generating investments includes other specialized instruments that funds might utilize, though often less directly accessible to individual investors. These include equity-linked notes, which we touched upon with JEPI, mortgage-backed securities, or MBS, and collateralized loan obligations, or CLOs. Briefly, MBS are financial instruments backed by a pool of mortgage loans, generating income from the interest payments on those mortgages. CLOs, on the other hand, are securities backed by a pool of corporate loans, providing diversified credit exposure. While these are complex instruments, understanding their existence helps demystify how some income-focused ETFs achieve their yields. The crucial takeaway for any income investor is the distinction between raw yield and total return. A high yield is only sustainable if the underlying assets are stable and the principal isn't eroding. Total return, which includes both income and capital appreciation or depreciation, gives a more complete picture of an investment's performance. Often, a fund with a slightly lower but sustainable yield and some capital growth potential will outperform a fund with a highly unsustainable yield that experiences consistent principal erosion. As we cast our gaze towards 2026, the economic environment is likely to remain dynamic. We could see a period of softening inflation, potential interest rate cuts following a period of tightening, or continued geopolitical volatility. These shifting macroeconomic factors will undoubtedly influence the performance of various income assets. For instance, BDCs with floating-rate loans could see their income slightly decrease if rates fall significantly, while REITs might benefit from lower borrowing costs. Covered call ETFs, designed for consistent income, tend to be more resilient during sideways or moderately volatile markets, which could characterize the mid-2020s. The goal isn't to predict the future precisely, but to build a portfolio that can weather different economic climates. Diversification across different income streams, covered calls, BDCs, and REITs, provides a robust strategy against specific sector downturns. Additionally, investors must consider the tax implications of these distributions. Income from covered call ETFs, BDCs, and some REIT distributions can be taxed as ordinary income, which might be less tax efficient than qualified dividends from traditional equity investments like schd.
Holding these high-income generators in tax-advantaged accounts like IRAs or 401ks can often maximize their post-tax return. Always consult a tax professional to understand your specific situation. This foresight, combining diverse income strategies with tax efficiency, is what truly sets a savvy investor apart, preparing your portfolio not just for today's yields, but for sustained prosperity through 2026 and beyond. Consider subscribing to our channel, like and share it with your friends, and comment the key thing you learned so far. So how do you weave these boring but brilliant income generators into your personal financial tapestry? The answer, as always, is rooted in your individual financial goals, risk tolerance, and time horizon. There's no one-size-fits-all best investment.
If you're nearing retirement and prioritize consistent cash flow to cover living expenses, then a heavier allocation to high-yield covered call ETFs, BDCs, or certain REITs might make sense. If you're younger and still accumulating wealth, a blend that includes dividend growth funds like schd, which provide capital appreciation alongside growing income, might be more appropriate. The true advantage of these boring assets lies in their consistent compounding power. Reinvesting those high dividends, even if they're smaller individually, can lead to significant wealth accumulation over time, especially when combined with their relatively lower volatility compared to pure growth stocks. This is where patience truly pays off. The hidden aspect isn't that these funds are secret, rather they're often overlooked because they don't promise explosive gains. They promise something far more valuable for many: steady, predictable income. But remember, the journey doesn't end with simply knowing the names of these funds. Thorough due diligence is non-negotiable. Dive deeper into each fund's prospectus, understand its underlying holdings, analyze its expense ratio, and scrutinize its management team. For BDCs, pay close attention to their loan quality and interest rate exposure. For REITs, understand the specific real estate sectors they operate in and their tenant base. For covered call ETFs, grasp the nuances of their option strategy. Are their payouts sustainable? Has their net asset value been stable or declining? These are the critical questions that empower you to become a truly informed investor. By dedicating time to research, you transform from a passive recipient of recommendations into an active participant in your financial future. This proactive approach ensures that your income-generating portfolio is not just high-paying, but also robust, resilient, and perfectly aligned with your long-term aspirations. The goal isn't just to accumulate assets, but to build a sustainable system that reliably puts money into your pocket. Understanding these boring but powerful income strategies is just the first step. Now it's your turn to take action. Which of these income-generating opportunities aligns best with your financial goals? Take a moment to research them further, analyze their fit within your existing portfolio, and perhaps even explore similar options we haven't covered today. Share your thoughts and any income ETFs you favor in the comments below. And if you found this deep dive valuable, consider exploring more of our content designed to help you build a resilient, income-focused portfolio for the future. Your financial future truly begins with informed choices.